Hi, everyone, and welcome back to the Wealth Clock with Steven Weinstock. Today, I'm joined by Jonathan Zamir, founder and CEO of Keystone Equities, a private real estate investment platform focused on credit and equity strategies. Under Jonathan's leadership, Keystone has closed more than a billion, or is that even more than that? I think I saw more than a billion.
It's a little over a billion.
A little over a billion. Okay. Has closed more than $1 billion in transactions, building a strong track record of structuring complex and special situation deals while forging partnerships with institutional capital partners. He's also the founder of Professionals of Real Estate Forum, a networking group that facilitated more than $10 billion in transactions. Yeah, 10 billion.
I'd say it's well above that now, yeah.
Okay. And he serves on the board of the Combat Anti-Semitism Movement. Jonathan, I'm really excited to have you here today. Welcome to the show.
Honored to be here. Thank you.
All right, Jonathan, first tell me where you're from, where'd you grow up?
All right. I'm born and raised in Manhattan, in the heart of it all. I grew up on the Upper East Side. I went to Ramaz school that was also on the Upper East Side, yeshiva over there. And I continued. I actually went to NYU Stern, the business school in the city. So the one rule I had was if I'm going to NYU, I'm going to study abroad one semester. And I did do that. I went to Florence, Italy, which was an amazing experience. And I've always grown up in the city. Ironically, I've moved out since I now live in Great Neck, Long Island, with my wife and three beautiful children, thank God.
Wow, nice. A true New Yorker. What's the first job you ever had?
The first job I ever had through a family friend, I got introduced to a brokerage company and I was 17 years old. It was a summer job. And they basically took what was at the time the big blue book. I don't know if you remember what that was, but that before the internet really was out there, they had the big blue book. They had every owner's phone number and they basically put me at a desk, slammed the book on the desk and just opened to a random page, pointed and said, start calling. And so I just started calling every single owner across Manhattan, asking them if they were interested in selling their building. And it was actually an amazing experience because as someone that's relatively sensitive, it desensitized me for better or for worse, because when you have people slamming the phone on you saying, stop calling me or leave me alone, it taught me that you go through all that hard work, but the one person out of the couple of hundred that you call, when they say they're actually interested, it makes it all worth it. And it was really an amazing experience. Ironically, you have to go through the crap, so to speak, in order to learn it, but it was really exciting. And that was my first job there.
Persistence definitely pays off in this business. So good for you. Let's fast forward. When did you start Keystone?
I started Keystone a little over a decade ago. I was around just over 30 years old, and I had worked prior to that for a very large developer who taught me a lot of the street smarts. And then I worked for a family office that taught me the book smarts on how to price risk and how to capitalize a deal. And I felt I could combine the two of those to really create a company that was dynamic and a bit unique and well positioned. And we got lucky early. We started buying stuff in New York City and Manhattan.
Let's break down exactly what Keystone does. Are you buying property? Are you acting as landlords? Are you facilitating loans and debt? Just give us a quick breakdown.
Yeah, it's a great question. So when we started Keystone Equities, we were strictly an equity platform. We were buying assets, repositioning them, generally selling them. We could refinance them. And we started off mostly in retail and office. We subsequently grew into every asset class other than hospitality. And what went from being focused strictly in Manhattan, we started expanding into Brooklyn, Bronx, Queens, and Long Island City. And then about 7 years ago, I started focusing a little bit more on tier 2 high growth markets outside of New York. And I could talk about my investment thesis, why we did that. But long story short, about 5 years ago, I did a hard pullback from equity just because I wasn't seeing much value, which actually worked out really well for us. Thank God. We avoided a lot more pain than we could have, and the market made us look a lot smarter than we are. But it was 2 years ago that when prices had reset, I felt there was an opportunity again. And we started getting into credit. A lot of capital stacks were upside down. And what we realized was, when people say, are you in the equity or credit side of the business? I think there's a gray area these days, because if you're buying defaulted notes, for example, you're buying debt, is that equity? We bought a $60 million note. And then what we realized was you could actually lend in the market today and make what were historically equity-like returns with credit-like risk and credit instruments, which was really attractive to us. So we got really active in credit in the last, 18 months or so, we've done about $500 million worth of loans. So we've been active on that side as well. And I'd say probably 70% of our time right now is on the credit side and 30% is on the equity side. But that shifts often depending on where the market dynamics are. Because right now we're seeing a lot more people playing in credit and it's getting a lot more competitive.
Where are you investing outside of New York City and the suburbs?
In the suburbs specifically, or you're saying across the country?
Across the country, outside of this area.
So across the country, there are we're at this point somewhat agnostic on the lending side, as long as we can like the underlying fundamentals and the asset and can get comfortable with the market. But obviously we like the tier 2 higher growth markets. Miami now is probably considered a tier 1 market. We definitely do like Miami. We're obviously mindful of the amount of supply there and everything else, but there are markets when we started focusing on tier 2 markets, you're seeing employees would rather live where there's a good quality of life and a good cost of living, and the employers had historically followed the employees. It's a lot different now after COVID, where people work remotely a lot more often, but still you see a lot more people in the Austins, the Nashvilles, the markets that you've heard about. We certainly like those markets. We continue to. We're just mindful. And on the equity side, it's a bit riskier just given the profile. So we really got to get a little bit more comfortable there.
When you started at Keystone, day one, were you backed by investors? Were you using your windfall from a previous job? Were you bootstrapping? What was the plan right away?
It's really funny. When I started Keystone Equities, I rented an office in my cousin's office, which used to be a closet, no windows. And I remember it because what I did was I just hustled. I have a list of people I wanted to reach out to and call, and I just pounded the phones and pounded the streets, looking around at where I saw opportunity. But had I known what I know now, I think I would tell you it was a pretty risky proposition. I had a lot of relationships, thank God, but at the same time, I didn't know if they would back me. And there's a very funny story, but it's a little bit of a longer story about how I transitioned. But suffice to say, I met one individual person that believed in me, and she was willing to essentially back me. And the difference between from Stonehenge, wonderful gentleman, always says a line, says, "What's the difference between a broker and an owner?" And I said, "What is it?" He said, "An owner can raise money. You can solve for execution. You can build a team around it. It's about being able to raise capital." And the day that one investor whose building I ironically had sold when I went out on my own, I inadvertently sold her building for her. And she said, "I really like you and I think you're smart and I want to see what else you're working on." I showed her a deal that was a $20 million deal, and she put up $1 million deposit for me. And that changed my business, because the day that happened, I went to an institutional fund that ended up liking the value we created on the deal and offered to buy the entire cash with us, $20 million all cash without any loan. And we went from there and it just grew from there. But I had a Rolodex of contacts, long story short, but I didn't know if they would back me. And I think if you create enough value in any deal, you'll find the money. It's more a function of being able to find the ARB in an asset that you're acquiring.
I read somewhere that you created a framework called, tell me if I have this, the 4 ways to buy a great real estate deal.
Yeah.
Did I get that right?
Yeah, one of the things I like to do, and I work with a business coach who always encourages me to go back and look at what I've accomplished in the past and learn from my mistakes, and also just try to build on whatever successes I've had. And that exercise is a really powerful exercise. I actually encourage everybody to try to do that when they can and if they can. But when you look at the deals that we've done, or that I think anybody's done, it really comes down to one of 4 categories, in my humble opinion. Number 1 is an off-market deal where the owner just doesn't know what they have. And it's harder and harder to do that these days because the internet's out there. Brokers are calling every owner. It's very easy for them to understand what the value of their asset is. I've done off-market deals. It's just hard to build a business that way because they're harder and harder to come by. Number 2 is you have an amazing relationship with the broker. The broker is going to give you first look, last look. He's going to basically help you get to that deal better than others. But that's a difficult proposition because brokers have a lot of relationships. And if the deal is that good, someone else may come and get it. The third one is having an angle. And I think this is where the most value is created. If you can build cheaper, if you can look at a deal differently than others, if you have a tenant in your pocket ready to go, you can create value. We had an asset that we bought for $41 million Before we bought the asset, we had a lease held in escrow for the second largest bank in the world that was naming the building their U.S. headquarters. They signed a lease with us for $1.8 million triple net just for the retail. So we bought the building for $41 million. And then within 6 months of buying it, we sold the retail alone for 36. I put it on the market for 40, but everybody told me I should fly a kite because I just bought the whole building for 41. But it created value, and being able to have an angle like that, it gives you arbitrage that really lets you pay more than others, but know that you're mitigating risk at the same time. That is where I think operators on the equity side have the biggest advantage. And then the last one is just having the most aggressive capital, or capital that really aligns in an investment thesis and is willing to put their money where their mouth is. You have some big groups that are really bullish on certain asset classes or certain geographies, and they're willing to underwrite more aggressive rent growth or tighter cap rates. They have a thesis there. So they're willing to pay more than others. But if you look at any deal that's done by anybody, it generally falls into one of those four categories. And the reason why that's important is because if you recognize where your value is, you can focus on one of those four categories and optimizing the way you're executing within them.
Are you bullish on New York City?
No,
Are you saying that as a landlord or as a first lien holder on property?
I'm saying it's a great question. I'm saying it as a landlord, but I want to clarify my answer.
Sure.
I think Mamdani poses a really big risk to the city. I think the city already has big issues. You've looked at, and people don't talk about it the same way, but obviously you look at the regulatory environment and stabilization, and there are owners that have owned these assets for many years. A lot of them have been wiped. And it's not because they've done anything wrong here. It's because the laws fundamentally don't work. When you have rents that you can't grow fast enough to catch up with your expenses, it's a depreciating asset. It's a ticking time bomb. And I understand the whole concept of affordability, but the reality is what's happened with the regulatory environment is it's created the opposite effect. Landlords now are inventorying units where they don't even rent them because it's not worth renovating them if they're not going to get paid for them. And the result is you're seeing it now. Free market rents have gone up incredibly high. And so if Mamdani does what he wants to do, it's just going to make the situation worse. New York is going to get increasingly unaffordable. I think there's a contrarian opportunity actually for investors to invest in free market assets, because if he wins and he tries to do what it is that he says he's going to do, there's just going to be less product available for individuals on the rental side, and it's going to get more and more expensive. So the reason why I'm bearish is because I think the budget in New York has major issues. I think Mamdani does not know how to balance a budget because he doesn't have the experience to do that. And that, with respect, but not being completely genuine. And I think that New York generates a vast majority of its income from real estate taxes. And if you start to see what's going to happen to the budget, taxes are going to go up immensely on real estate. And it's just going to feed itself where we have to generate even more revenue than we have. And if you can't raise the rents, it doesn't work. And if you can, you're going to raise the rents just to make up for those expenses.
If somebody was coming to you for advice, a young 25-year-old, 28-year-old, and he was putting together his first deal, he has, I don't know, $5 million committed from family, friends, his network. He wants to buy a $15 or $20 million residential property. Would you tell him to avoid New York City?
Not necessarily. I think I would tell him to just have a thesis as to what it is he's investing in. I think it really depends what you're investing in. Asset classes are different. And I do think New York is New York. I do think there's a value to be, as bad as Mamdani may be, if he wins, you got to go through difficult times in order for people to turn back around. The pendulum swings the other way. So if you have a long-term purview and you're considering investing from a long-term perspective, it might come back the other way. People might realize that we made a mistake and look at San Fran and other places that really have gone through a difficult time. The problem there is if you're going to have to hold on to an asset for a long time, you're not going to get paid. And I think one of the biggest mistakes entrepreneurs make is they don't do the math. And I know that sounds really odd, but the reality is I've sat with a lot of young guys. They're looking to go out on their own. The first thing I ask them is, tell me your business plan. the response is, I'm going to go buy buildings. I'm like, okay, let's do the math. And I said, okay, if you buy a $5 or $10 million deal, is that good? They're like, yeah, that's great. I said, okay, let's say you buy 2 of them. And then we do the math. I'm like, okay, you make an acquisition fee, but that has to go into the deal because your partners want to know you have skin in the game. Your asset management fee is minimal. It's barely going to cover an individual. So you're going to need to hire somebody. You're also going to be stuck running these properties and you won't be able to have the time to find a new deal. And your hope and expectation is that you're going to be able to exit and earn a promote. But the world doesn't necessarily work that way. I'm now old enough where I've gone through a lot of ups and downs, and I've seen people that have done everything right when it comes to the execution of the business plan, but the macro market just crashed on them. So it's really difficult. And so I would tell people to just really think through what their investment thesis is and how long the investment horizon is, because it's critical.
What do you do when you're not focused on real estate? What do you do for fun?
I love my family first and foremost. I'm blessed with 3 amazing children. Today's my daughter's 7th birthday. So
Happy birthday.
thank you. But in addition to that, I love playing sports and spending time with friends. Between tennis and soccer and other sports, that's always been a passion of mine. I like to read when I can. It's more a matter of finding the time more than anything else.
You ever travel for business?
I do travel for business. I travel for pleasure more than I travel for business. I
Any-
love traveling. That's always been a passion of mine.
Anywhere exciting recently?
I'm actually going to Italy in a couple of weeks, which I'm super excited about. My best friend's getting married, so we're going to go up in the north by Lake Garda. Should be really beautiful.
Oh, very nice. Very George Clooney-esque. Okay, very nice.
Far from.
Where do you see Keystone in 5 years? Do you see yourself focusing more on the credit, maybe on the equity side and being a landlord?
So we still are active on the equity side. I'd like to continue to build a credit platform, maybe raise a fund eventually on that side. And in addition to the credit side, we want to continue doing one-off equity deals. I think the credit side is the way to build scale and team. I think equity is the way to build wealth. One of the biggest challenges in the industry I find as an entrepreneur is you have these very large funds that have the capability to hire a lot of great talent. And when you're an entrepreneur, if you don't have a fund from a cash flow perspective, it makes it a lot more challenging because funds are earning their management fees that pay for team. But as an entrepreneur in real estate, you generally don't have that unless you have a good amount of assets under management. So if you build a credit platform that builds you are earning some fees there that helps you build team, and you're only as good as your team. Like one of the things I've been focused on is building a team that's much smarter than me, which is not saying much, but at the same time, it's incredibly humbling because by virtue of doing that, it ends up really empowering myself, but also it's 1 + 1 = 5. It's really exciting to hire individuals that are really capable.
What led you to start or create the Professionals of Real Estate Forum, the networking group? Tell us about it.
Yeah. So I started PREF in 2006. At the time, I took 17 of the most active up and coming real estate guys, the younger generation, so to speak. And I looked at them and I said, look, our network is everything in this business. I want us to be there for each other. I want us to support each other, almost a frat, so to speak. But rule number 1 was like the Fight Club. At the time, it was like no one talked about being a member of PREF. And it grew into this, I didn't even know what it was going to grow into, but I'm very humbled. It grew into this amazing organization with 80 members and wait lists, a lot of people applying to join. And we had sponsors, large sponsors that would help support the organization. And it grew into this amazing platform where I've been really fortunate to make amazing relationships that come in handy every day now of my business. Individuals that at the time were very smart, up and coming, are now running some of the biggest institutions in the country. They've shifted up the corporate ladder and they now sit in really high seats. So I will say, I think there's a lot to be said about having a strong network. I also think it's one of the biggest pitfalls with work from home is people don't get the opportunity to build real relationships and to meet their fellow peers in the industry. And I cannot stress strongly enough how important I really think that is. The PREF has been an amazing vehicle and something that just seeing your friends being able to work together, do deals together, and to trust each other and make introductions, it's a really powerful tool.
I was just going to ask you whether you prefer networking online or in person, but I think you answered that for me.
Nothing like it. We do work from home, our team at times, but we do meet up in the office. And I will tell you, we are incredibly more efficient or together in person. But there's something to be said about having alone time and just getting stuff done as well. I think during COVID was the first time, and my parents come from a generation where if you weren't suffering, you weren't working hard enough. And I'll never forget it. During COVID, I was in Miami. I ran away to Miami during COVID. I was fortunate to do that. I closed the deal on the beach. I was literally on the beach and I signed docs on my iPad. And I just looked over at my wife and I'm like, this is nuts. She's like, what? I'm like, I just closed the deal on the beach. And she looked at me, what do you mean? I'm like, you could do it these days. And it was just like a very eye-opening experience, but it was just interesting.
Yeah, DocuSign really made things a lot easier.
I don't know if you remember the notaries that were online. They're like, we'll notarize the document for you online. I'm like, okay, fine, no problem.
Yeah, yeah. If you weren't living in New York, where would you live?
It would either be Israel or Miami.
Yeah, I agree.
Honestly, there's no place in the world like Israel. Miami's great. My brother and sister live there. I have a lot of cousins that live there, but Israel's Israel.
Yeah, yeah. I got to visit a few times last year. Hopefully this coming year as well. But Miami too. I got to visit a few times last year, and if stay stateside, Miami is great. Moving to Israel is nice too. It's definitely a tough move while raising kids, I think.
That's the catch. That's the rub.
Yeah, yeah. I'm in the same boat. I hear you. Jonathan, I had a great time talking to you. Thank you very much for coming on.
My pleasure.
Tell our audience how they could reach you. If you want to give your email, you want to give your phone number, I'll put it in the show notes, whatever you put out here. You want to give them the last 4 digits of your social security, go ahead, whatever.
Anything else I should add, or I think the best way to reach me is on LinkedIn. I would say just go to Jonathan Zamir and you'll find me there. And you're welcome to message me there. We also have our website, KeystoneEquitiesLLC.com, where anyone can reach out to us on that front, and would love to connect with anybody and everybody. We're very active right now. We continue to stay active, and we're growing, Baruch Hashem. Grateful for everything.
Okay. Thank you everyone for listening. I will put everything he mentioned in the show notes. Click subscribe, forward, share, and I'll see you on the next episode of The Wealth Clock. Thank you.
Thanks so much for your time.